Okay, so for this episode, let's take a look back for just a moment at where we were at the start of the year 2000. Remember that? The end of the dot-com era. Well, the markets, remember, they were up substantially from where they were from even just a few years earlier, and the NASDAQ was on fire, and there was some talk in some circles of this new paradigm in investing, according to many so-called experts at the time. Remember that? There was a lot going on. Well, markets were at or near record highs, and many people took the market trends as a sign that they should abandon diversification and focus strictly on U.S. stocks in the Dow, the S&P, or the NASDAQ. So what happened? Well, 10 years that followed gave us a negative 0.6% annualized return with dividends reinvested in the S&P 500. Many people have called this the lost decade. So now, fast forward to today. The ongoing bull market is by some measures the longest bull on record since 1950. Pretty cool, right? And even though we've hit some rough patches lately, there's still talk in some circles about stocks even going higher, which may have the effect of turning the focus away from diversification again and into investing in the 500 largest domestic stocks. So doesn't this sound familiar? Well, it should. The truth is nobody knows what the next 10 years in the market will bring. We've seen a lot of volatility lately, and we'll probably continue to see that going forward. But if you were a diversified buy and hold investor, for example, who reinvested your dividends back in 2000, you may not have experienced that lost decade in stocks. So consider that going forward. And over that same time period, the Russell 2000 index of small company stocks generated a 6.3% return, and U.S. real estate stocks earned a 3.9% return, and emerging markets, get this, generated a compounded return of 16.2%. So the point is that diversification can really make a difference. It's not glamorous, but it could provide a great deal of protection on the downside. If you broadly diversify your equities by size and asset class, geography, and simply hold on, you may actually see better results over the long term.